Welcome to Greystone Capital Group, where we invite you to embark on an extraordinary journey towards a life of abundance and fulfillment. At Greystone Capital Group, we specialize in the transformative power of passive investing in commercial real estate. Your journey to financial freedom and a fulfilled life begins right here. Subscribe now and let Greystone Capital Group be your guide to shaping a brighter tomorrow.
Hello, Mauricio. Thank you for coming on the show.
Yeah, thanks for having me, Jonathan. Really looking forward to talking to you.
Yeah, I'm really excited today because today we're going to talk about some wonderful topics that I love and I know you're expert in. So I want to get to your intake. And first, let's talk about your background, Mauricio, so people know who you are.
Yeah, so I mean, I've been a practicing attorney now for I think 25 years now. Today, yeah, it was 1999 is when I first started practicing. So, yeah, I'm originally from Chile. Went to school up in the San Francisco Bay Area at UC Berkeley, and then I went to law school down here in Los Angeles, where I'm in SoCal, and I went to work for a great law firm that really specialized in securities laws, but on the litigation side. So I was representing some of these big securities firms like JP Morgan, Merrill Lynch, American Express, Goldman Sachs, whatever. But it was when they got sued. So I was a defense attorney. They would get sued. I'd file the answers and do the depositions and do the trial work and the arbitrations and the mediations and all that fun stuff. And it was a great firm to work at. Obviously cut my teeth there for, I think, the first 7 years. And then I just wasn't super happy there, right? So I knew there was something more than just getting stuck in that rat race. As you can imagine, as an attorney, you're billing hours and every 6 minutes of your time. And I was, luckily for me, man, I'm sure you've come across this too. I came across that little purple book, which is Rich Dad, Poor Dad, which I got somewhere around here. And that really changed the course of my life because, number one, it confirmed that there was more to what I was doing. I just didn't want to keep doing what I was doing until I was 65 and then retire and, do that stuff. So that kind of confirmed that. But what it really did is it introduced me to another completely new group of people in the real estate world, primarily the real estate guys. Was long story how I got there, but it's through Robert Kiyosaki, who's established a really good relationship with the real estate guys, went to work for the real estate guys. And that's where I really cut my teeth on syndications. They were doing a lot of syndications back in the mid 2000s, like 2005, 2006, which is when I went over there. And as their general counsel, I did all of their PPMs and all their capital raise and stuff. And Jonathan, you get a kick out of this. This is old school. So this is literally almost 20 years now, right? And or actually it was 20 years ago. It was 2005. Yeah, it's 20 years ago. And there was social media, but it wasn't what it is today. And there's certainly no webinars. I mean, literally you would do a pitch in a physical room. You would invite, 60, 70 people who would show up. I was there with all of my printed out PPMs. They would ask me questions and I would answer. They would sign the PPM, write me a check, not me a check, but write a check, hand it to me. And that's how we were conducting business back in 2005, 2006, which obviously we've come a long way now. I don't think anybody does any pitches in person. I think webinars are starting to become more and more popular. Even webinars people didn't usually do about maybe 5 or 6 years ago. But anyway, that's how kind of really where I cut my teeth on syndication stuff. And that's where I got my stuff today. I then left the firm. I started helping out some of their guys with some asset protection, some entity formation, LLCs kind of stuff, and basically started my own firm back in 2007, Premier Law Group. Kept them as a client, obviously a VIP client, and then grew my practice over the last 15 years or so. Initially, as you know, Jonathan, you start a company or start a business, I was taking anything that put food on the table. So contract, whatever you wanted, man, I was going to do. And then I slowly narrowed that down to syndications and asset protection. I'm now, as of 2017, 100% syndication. So I gave up the asset protection world, but I still consider myself, one of the foremost experts in asset protection. I talk a lot about asset protection, entity formations, wrote a book on it. But I don't practice that anymore, which I actually like, because then I can give you the real deal. I'm not here to sell you an LLC or a trust or a series LLC or whatever nonsense registered agent say. I'm just here to give you the pros and cons when it comes. So I'm really enjoying doing the content on asset protection. But our bread and butter now is the syndication world. All of our clients, 100% of our practice is real estate syndications, primarily multifamily, but we do a lot of self-storage, a lot of mobile home parks, a lot of, just anything really, a little bit of retail, not a ton, but a lot of multifamily. And that's all we do, real estate syndications. It's been, we've really caught that wave when I turned to it 100% in like 2016 or 17. I mean, we just rode that amazing syndication wave till about 18 months ago, right? 18 months ago, right around July of 2021. I think that's where it kind of peaked, and it took a little bit of a hard fall at the end of 2021, and it's really hasn't recovered much. It's still kind of hovering in
Yeah.
that on the lower
Mhm.
range of that. Honestly, I would almost call it a collapse, at least from the transaction side. I've
Right.
talked to a lot of other, obviously, real estate attorneys. I've talked to brokers, lenders, and everybody talks about a good 60% drop in transaction volume, which is also supported by the SEC data, because there's about a 62% less Form Ds that have been filed. At least this was about a few months ago, for the past 12 months. So here we are today, real estate syndicator. I got a couple podcasts going, a couple books, and just really enjoying sharing my knowledge. And my good friend Tom Wheelwright likes to say I'm one of the few attorneys that actually speaks English. So I like to take these complex, I know we're going to talk about funds and fund of funds and securities laws and investment company, all this kind of stuff. And I
Right.
like to distill that in something that's easy to understand.
Right. I like that. I love that you have asset protection and syndication. You've been an old school long time. And I guess when does the law come out to do syndication? It was a long time ago, Mauricio. You do syndications?
Say that one more time. When did I start doing syndications?
Yeah, I mean, when did the law allow you to do that? Long time ago? Syndications?
Oh, well, I mean, syndications has been around. Well, I think what you're referring to is that at some point it was a 2013, actually passed in 2012, but 2013 brought in the 506C exemption, which allowed people to go out there and advertise. And that's really, I think, part of the explosion. It took a couple of years to get going, but now that you can actually advertise your deals, go on social media, podcasting is obviously taking off. So you can do a podcast like we are today. I mean, if I was a syndicator right now, I could be doing a 506C deal and just literally say, hey guys, if you're interested, I've got this deal, this apartment in California, and it's amazing, and call me, and I can literally pitch that on the podcast, which is not something I could do prior to 2013.
Right, great. And you have to be a credit investor. And is there any new rules came out? Any taking a test or something? Is that something come out
Not yet.
recently?
So it's important for people to know whether they are accredited or not accredited, because some of these deals are only available to accredited investors. And even if you're not accredited, some of these deals limit to how many non-accrediteds can be in your deal, which is why it's so important. But right now, the definition has changed slightly over the years, but basically it's been the same for a few years now. $1 million in net worth, excluding your primary residence, or $200,000 a year for the last 2 years, with a reasonable expectation of earning $200,000 or more this year. If you're combining that with your spouse, that's $300,000. And then the update from a couple years ago is they added some licenses. So if you're a registered investment advisor, you have a Series 7, Series 82, or Series 65 in good standing with your state, you're also an accredited investor regardless of your income. There's been a lot of rumblings, a lot of bills have passed the House of Representatives, a lot of SEC rules have been sort of proposed, and actually one of them did pass, where there seems to be a movement towards two things. One is having the opportunity to go take a test instead of having to rely on the net worth or income requirement, that you can go take some kind of a test and just get certified. But at the same token, they're also talking about maybe increasing the limit of the accredited investor dollar number. So instead of being $1 million, you may have to now have a $3 million or a $4 million or $2 million, some number
Oh,
higher
wow.
than $1 million. And so I think both are going to happen. I've been talking to this for a little bit, and my guesstimate and my thoughts, I think, were confirmed last December when the SEC came out with a paper, and basically, honestly, I was joking that they were probably watching my content. Literally said the same thing I've been saying for the last 2 years, which is, when this passed in 1982, when the accredited investor became $1 million in 1982 was a lot of money. And if you just adjust for inflation, that number is almost $3 million today in 1982 dollars. So I have a feeling, and the SEC talked about that the $3 million mark seems to be somewhere in the ballpark, that it'll probably happen. And then it's not the end of the world. If you are accredited today and tomorrow you're not because you're less than 3 million, then great. You have a path to go take a test. I mean, I think that's what's going to happen. You either automatically qualify, which will be harder, or you can go take a test, an exam, and get certified as an accredited. That's what I think is coming down the pipeline here in the next 12 or 24 months.
Okay, interesting. So the new rules, yeah, it's gonna be harder to qualify because they want
Automatically,
more.
yeah. I
They
think
want
so.
more
I think
net worth and stuff like that. Yeah. Okay.
yeah.
Unless you pass the income test, if it still remains the same, you make 200,000 or more, then you're still accredited, right?
Yeah, and we don't. It's people ask me about the income part. There's been no mention of what income would go up to, but it certainly wouldn't triple, because that would be like 600 grand, and that puts you like in the top 0.07% or something. So I don't know if income will go up. I mean, 200 grand still, puts you in the top. I think you're less than top 10 at that point. But so I don't know if the income's going to change, but the net worth, $1 million in net worth just isn't, especially with real estate prices these days. Your home is a good chance you got $1 million just in your home, and your 401k.
Okay. Okay, great. And Mauricio, what do you feel about this? Everyone's saying distress this should be coming and a lot of capital calls. So you've seen a lot of capital calls, right, from your
Yeah,
clients
I
and
see
everything,
a
right?
ton of capital calls. So I'm usually not involved. Obviously my job is to make sure people raise compliantly. So once people are off to the races and they've closed their properties, I'm not really, I'm kind of forgotten until they're ready to raise more money. But one way we do get brought back in is if they're in trouble and they're thinking about doing a cash call, because that's going to be, they say, hey, how do I do that? And that's going to be based on the documents that we drafted. So because we draft a document called, the operating agreement, and how a cash call or anything really happens. When people ask me, like, what's the procedure? How do I do this? How do I do that? You just got to look at the operating agreement, because that's what governs. And so we've been counseling and talking through some clients in terms of, hey, this is how you have to do a cash call properly. Make sure we follow the steps, and there's a process in the operating agreement that you just need to follow.
Yeah, yeah, right. And that happening a lot. And do you see any distress this Mauricio in this year or last year that's
Oh,
coming?
100%. I mean, it's just kind of slowly rolling through, but at the peak in 2021, the bridge debt was all the rage. So what happened was COVID came along and really blew up the real estate prices. Prices went up really fast, but the incomes didn't keep up. And so it was very difficult to get conventional financing, because your debt coverage ratio just wasn't there. There just wasn't enough net operating income to justify the loan, even though the valuation seemed to be higher. And so they could get loans conventionally, but they could only get 60% loans or 65% loans, just because that's what they could, the property was doing. And so people started moving towards a little bit more riskier loans, which were these bridge debts, which were 3-year loans. They were 3 years plus one, but we were talking about it back then. That didn't automatically mean, and people are finding out, it wasn't an automatic plus one. So those 3-year loans, if you took one out in 2021, it's coming due in 2024. And if you took it out in 2022, it's going to, so these loans that are these 3 plus 1+1, as those start expiring, so we're in that window, we're literally in the thick of that window. The valuations have come down, cap rates have obviously gone up. And so people cannot just refinance and get another loan. They either have to sell the property, which is tough because they got to sell it for a loss. They can't refinance. Rate caps was another big thing. The insurance that people were buying to make sure that their interest rate didn't go above a certain amount as the Fed really increased interest rates. Well, those are expiring too. So imagine you bought a property in 2021 and you got it at, say, 4%, and you bought a cap at 6%. So you knew it wasn't going to go higher than 6. Well, now it's at 6, because you're obviously interest rates are way above that, not way above, but a little bit above that. And now once that cap rate expires, you're going to be at 7.5, or whatever the current rate is on your commercial. And those are just not sustainable. Certainly going to fall. Your debt coverage ratio is going to be below what the lender's looking for. And a lot of times below 1. So there's actually not enough money to cover the debt. And so the banks are like, hey, some are working with them, especially if they're good, operators and have a ton of other businesses. Maybe they'll do some loan modifications, but honestly, most of them are just looking for an exit and trying to shop the deals around and get another operator to come in just to buy it for the price of their loan. But honestly, some of these deals aren't even worth the loan. So,
Yeah,
you
so
may have bought
that's
something for 25 million. You have a $20 million loan on it. Great. But, the LPs are wiped out already. But if the property is worth less than 20, then, the bank has to take a haircut. Otherwise, nobody wants to touch it.
yeah, I've seen some of those recently where it is a bridge debt and he was due like in April or something, and he had to sell at lower basis, obviously, because
Yeah.
just to make it, so.
Yeah. And the one thing I'll counsel everyone is just, it's really been amazing to me to see that a lot of, when things go bad, my buddy Ken McElroy, who's actually the one that made me write this book, but my buddy
Okay.
Kenny, who's a really great syndicator, he always talks about communication is key. And as things go wrong or things don't go according to plan, that's the time to double or triple your communication with your investors, not the time to stick your head in the sand. And it just amazes me that there's a lot of folks that have lost properties where the LPs don't even know what's going on until it's too late, or they even find out about it on some, social media post or something.
Okay.
And so if you're having trouble, it's happening. You're not alone. Not everybody's having trouble, but a lot of people are having trouble because their, interest rates have gone up too fast, or rate caps are expiring, or, their bridge loan is expiring. Talk to your investors the minute you see. Kenny was talking about some issues last year where, some of his loans were coming due in like 18 months or 2 years. And he was already starting to talk about, hey, this is gonna, this loan, we need to refinance this in 2 years. And we're starting to do these things or that things. He did a couple of bail-ins, and not bail-ins, but he did some cash in refinances where instead of doing a cash out, you actually put more money in to buy down or either buy down or to maintain the interest rate. But again, just got to be thinking ahead of time. Don't wait till it's way too late and hoping things will get better. Communicate with investors quickly.
Yes, exactly. We do a monthly update to our investors,
Yeah.
so it's great. So let's talk about this. I know the funds was gaining traction in the past few years. In your opinion, if you were a syndicator, would you recommend a fund model versus single asset syndication?
A fund model is great if you can pull it off. I mean, it's just harder in general to raise money for a fund than it is a project specific. So if you're just starting out, would it be great to have all the money in the bank before you buy something? Sure. And who wouldn't, right? But it's just harder because people don't see the business plan. They don't see they don't know what you're buying. So they're just relying on you and they're relying on your fund criteria, but they don't know what property they were buying, what it looks like, what the debt looks like, what the business plan, what your assumptions are. They can't challenge what your rent growth assumptions are or your value add assumptions. And so they're really blind. So they really have to, trust you. And so the only real way that my clients, if you've never done a deal before, is if you have a huge audience. A lot of clients have big podcasts, big YouTube followings. Okay, great. You can probably put a webinar together and attract people. Or you just have a track record. If you've been doing 3 or 4 or 5 or 6 or 7 of these, and now you've got your base of investors and they know you and they don't want to go through that whole thing, maybe you raise a fund. But I don't have anything against funds. I know it's harder to do. If you can pull it off, hey, why not? Why not raise the money, have it in your bank account? You're going to have some great leverage. You're going to have some advantages over other people. You might get bulk discounts, or, if you're neck and neck with another potential buyer and they have to go raise a bunch of money and you can show them that, hey, you don't have to raise the money. It's in your bank account. You do have some advantages. It's just harder. So if you can pull it off, I love it.
And let's talk about this customizable funds versus the blind fund. What would you say the pros and cons of like something like a investor versus like a regular blind fund pool?
Yeah, so I mean, there's pros and cons. If it's done properly, customizable funds they've been called different things. They've been around for a while, especially in the private equity world. It's just more complicated. I mean, the biggest thing I have with the customizable funds, I think, is primarily not the actual product itself. It's the way it's been marketed. So people market it as something like easy and fast and cheaper and quicker and whatever. And it's the opposite. It's more complicated. It's got way more risk, especially for the investors. The investors get very little benefit from a customizable fund. From an investor standpoint, you're better off just like having 5 different syndications and just picking whichever syndication you want, because then you don't have the exposure from the other 3 or 4 syndications. Because when you do a customizable fund, the LP is part of the fund. And so if something happens to another property, even though they're not getting any benefit from that other property, if there's a lawsuit or something catastrophic happens, they're going to be affected. And so from my perspective, no big deal. It's just a disclosure. We just disclose all the risks and we tell them what it is. And then where I think people forget is every time you add an asset to a customizable fund, you've got requirements to give them disclosures at that point. And I think a lot of these models at that point rely on sort of do-it-yourself model, where it's like, hey, here's a format, a template, just fill this thing out. When really you need an attorney, a securities attorney after each asset to disclose the risks of the asset itself, the risk of the marketplace, the risk of the loan product, all those risks. Somebody needs to determine what disclosures need to go to the investors. And a lot of these customizable funds, they're just doing that on their own. That's the reason it's cheap. It's cheap because you're not having an attorney do the paperwork. You're having an attorney do the main paperwork. But then when you have a new asset in the fund, you're supposed to go back to the attorney and have an addendum to your PPM, and people aren't doing that. They're doing it on their own, which is problematic.
I see. And I think for accounting, it's much more complex because you're trapping in each silo, each asset in a customizable fund. So it's actually in a way, it's kind of like, it's tricky because you have 3, it's almost like a 3 syndication into one fund.
Yeah,
but
it's
you have
doable. I mean,
liability.
like I said, it's doable. I mean, we've done it before and we work with the CPAs, but the CPAs aren't a huge fan of it because it's super complicated. And so we draft the language. We have to show it to the CPA. And so it's more expensive because now you're talking with the CPA's got to be involved and they're involved. It just does complicate things. But again, it's not that it can't be done. If clients really want to do it, where it really makes a ton of sense is when you're syndicating really small amounts, like, you're raising 300,000 for this one, 250. It doesn't make sense to pay the compliance costs for all individuals. So on that one, I could see an argument that, hey, let's do a customizable. But other than that, I think just people don't realize that you need to go back to that original attorney and have them prepare an addendum to the PPM, because every time you bring in a new investor into your fund, you're required to give them the full disclosures. And obviously you can't just give them a disclosure from a PPM from 3 months ago that didn't have any assets. And now you've got 3 assets and you want to disclose the particular asset that they're buying into.
Great, Mauricio. Great, awesome. So let me ask you this. I know recently, funds of funds, SPVs have been more trending lately. And so in your mind, when should someone do a fund of fund versus just regular, I guess co-GP model and be part of the team
I actually prefer the fund of funds over a co-GP model. The problem with the co-GP model is it's getting out of hand. Like, there's one thing if you have two or three people as a co-GP and somebody's coming in because they're boots on the ground, or maybe, you're a good example. Like maybe I'm a self-storage person, but I want to venture now into multifamily. It's like, hey, let's bring in another person who's got more experience than I do in multifamily versus self-storage, or vice versa. But now these things are getting crazy because there's like 6, 7, 8, 9, 11, 13 GPs. Somebody in there is just there to raise money, and that's the problem, right? So when you're just there to raise money and you're not doing real work, that's problematic for everyone. It's problematic for the person bringing in the money because they're acting as an unlicensed broker, and it's a problem for the syndicator because they're not disclosing that they're paying an unlicensed broker. Like, why would you, right? And so the way around that is to do a fund-to-fund model where you actually create a fund, almost like think of it as like a mutual fund. You create a blind fund, you raise a bunch of money into that, and then you go out and start looking for and interviewing. Hey, I see Jonathan over here has got a great self-storage fund. Let me do my research on Jonathan. Let me go check out the properties and the investments. And yep, I like it. Let me put 500 grand over here. And then I go over to this other guy and look at that. And so you're basically picking and choosing the investments, and that's what you're getting paid for. No problem. So I like the fund-to-fund models more than having more than, let's say, 5. Once you get past 5 GPs, I get nervous.
And a fund of fund, I guess you come in as an LP, as a fund of fund.
Yeah, when you do a fund of funds, the key difference there, it's a very subtle one, but instead of you raising money and buying real estate, you're now raising money and buying shares in somebody's company. I mean, they're membership units in LLCs, but essentially it's no different than buying Google stock or Tesla stock. You're buying a security. You're not buying real estate anymore. And the problem is once that happens, now the whole compliance world really increases because now I'm not really a real estate fund. I'm really a private equity fund firm. And now I got to worry about all the other investment advisory rules and Investment Companies Act and broker dealer rules. I mean, there's a myriad of other regulations I got to look at that I didn't have to worry about when I was just buying real estate.
And I think at the federal level, 3(1)(c), if I'm not mistaken.
3C1 exemption, yeah. So that's one of the pieces. So one of the pieces is the Investment Companies Act, right? So you don't want to become an investment company because then you fall into this act and it's another bunch of nonsense regulation you got to deal with. And so the easiest way to get exempt from having to register as an Investment Companies Act is through an exemption that you mentioned, which is a 3C1 exemption, which basically says as long as you have less than 100 members in your LLC, you're exempt. And so that's where the 99, sometimes you hear the 99 investor rule because, you as the manager, you're one of the members. So if it's just you, you're limited to 99 investors. If it's you and a partner, you're limited to 98 investors. So as a total, you're limited to 100 investors. And if you get less than 100, then you would be exempt from the Investment Companies Act. But that doesn't mean you're exempt from having to register as an investment advisor somewhere, or it doesn't exempt you from having to worry about the broker dealer rules either.
So I guess that's from a federal level. At the state level, is there any rule, I guess, any rules from the Investment Company Act at state level?
Well, the Investment Companies Act is a federal rule, but yeah, the investment advisory is usually a state issue because you don't qualify to register at the federal level because typically you have less than 150 million in assets under management. So it becomes a state issue. So what state do you live in? What state are you advising your fund? And each state is different. Some states like Hawaii don't have an exemption, so you have to register as an investment advisor. Other states have an exemption and it's really easy. So as long as you don't do more than, 5 or 10 or 15 of these. Some limit you to accredited investors only, and some limit you to qualified clients, which means $2 million in net worth. So you just got to look at the state. But I love that you're bringing this up because, I don't want to get in the weeds and you don't have to worry about all this stuff specifically, but there is a lot more compliance that you have to worry about that you don't have to worry about when you're investing in real estate. When you're doing a fund of funds, you got to check off a bunch more boxes, which is why you need a securities attorney who just has all of this in the back of their heads and can just quickly identify, hey, you live here. Let me take a look at the statute. Yes, you're exempt. No, you're not. Here's the requirements.
Good. People can come see you, seek guidance for funds of fund and all these complicated rules from Investment Company Act to Private Funds Advisory Act, and be you becoming a private fund advisor or manager. And there's a separate rule too as well.
Yep. And Jonathan, just a reminder, I do have a hard stop in 4 minutes. So we got to the bottom of the hour here, but so editor, check that out.
Yeah, no problem. No problem. Yeah. So Mauricio, so how will people reach out to you? And I think you have also a book you want to
talk about. I know we're going to run out of time, but legal strategies for everyone. You can go to the website, legalstrategiesforeveryone.com. It's a book that Ken McElroy actually asked me to write for his publishing company. And it's a very introductory level book on just legal concepts. And so if you're new to the legal world, and you want to learn, for example, about asset protection and insurance and privacy and how to set up LLCs and how to set up a trust, or how to do an estate plan, having a will or a trust, or how to raise money for other people, it's all in there. And it's been a great project, and it just came out actually a couple weeks ago. So really proud of it.
Great. Well, awesome. Well, thank you very much, Mauricio.
Thanks, Sean.
Have a great day.
I appreciate it.